Here's a paradox that should make you reconsider everything you think you know about markets. During a government shutdown that left economists flying blind without crucial economic data, the Dow and S&P 500 hit 3 consecutive record highs. How does Wall Street thrive while Washington shuts down? The answer reveals the strange disconnect between political theater and economic reality. As of early October 2025, stocks moved higher despite the government shutdown, with the Dow gaining 239 points and both major indices clinching fresh records. This isn't investor delusion, it's pattern recognition. History shows that government shutdowns are typically short-lived with minimal long-term economic impact. As CFRA research's Sam Stovall noted, shutdowns have been more headline events than bottom-line affecting events. Markets have learned to distinguish between political dysfunction and economic fundamentals. But here's where it gets genuinely concerning. The shutdown created a government data blackout. With the Bureau of Labor Statistics' crucial monthly jobs report postponed, along with data from the Bureau of Economic Analysis and Census Bureau, investors, economists, and policymakers suddenly lacked the gold standard indicators they rely on to assess economic health. Think about the implications. The Federal Reserve makes interest rate decisions worth trillions of dollars based on employment data that simply was UNT being published. Without official data, investors turned to private alternatives like ADP's payroll report, which showed the private sector shed 32,000 jobs in September. But as UBS Global Wealth Management's Paul Donovan observed, private data is like viewing the economy through a keyhole clear, but with a narrow field of vision, while official data is like opening the door. The market was essentially navigating by partial information at a moment when stocks were historically expensive and vulnerable to surprises. So why did stocks rally anyway? 3 factors. First, relatively strong corporate earnings and enthusiasm about artificial intelligence continued driving gains. Companies were still making money, regardless of whether government statisticians could count it. Second, investors anticipated Federal Reserve rate cuts, which typically boost equity valuations by making future profits more valuable in present terms. Third, and this is crucial, the absence of bad data isn't the same as good data, but markets often treat it that way. No news became good news by default. Yet this complacency carries real risks. Bankrate's senior economist Mark Hamrick called the timing particularly ill-timed, noting that the lack of updated labor data coincides with other signs of fragility in the economy. Translation, we're potentially missing warning signals at exactly the moment we need them most. Nomura's chief economist David Saif warned the Fed was flying blind, potentially making rate decisions without top-tier data. Between September and late October, this reveals something fundamental about how modern markets function. They're simultaneously incredibly sophisticated, processing vast amounts of information, instantaneously and remarkably short-sighted, often prioritizing immediate momentum over uncertain risks. Keith Buchanan of Globalt Investments captured this tension, saying the market is being a little too sanguine and doesn't appreciate the risk of a stickier, more contentious shutdown. The broader lesson extends beyond this particular shutdown. We've built an economic system that depends on constant, reliable information flows from government agencies. When those flows stop, we don't pause, we improvise with inferior substitutes and hope for the best. It's like flying a plane after the instrument panel goes dark. You can still navigate by looking out the window, but you're missing critical information about altitude, speed, and atmospheric conditions. There's also an uncomfortable political dimension. Markets essentially telling politicians that shutdowns don't matter creates a moral hazard. If there are no immediate economic consequences, what constrains this behavior? The financial sector's indifference to governmental dysfunction might inadvertently encourage more of it. We've separated market performance from governance quality, which would have seemed impossible to previous generations who viewed stable government as prerequisite for economic prosperity. The Dow, S&P 500, and Nasdaq each ended the week with gains of more than 1%, proving that in the short term, markets care more about corporate profitability and monetary policy than political chaos. But sustainable economic growth requires more than quarterly earnings and algorithmic trading. It needs infrastructure, investment, regulatory clarity, social stability, all things that deteriorate when government shuts down, even if stock indices don't immediately reflect it. The real question isn't why stocks hit records during a shutdown. It's what happens when markets finally realize they've been navigating without instruments in increasingly turbulent conditions. History suggests shutdowns are brief and harmless. But history also shows that the last time things worked doesn't guarantee they'll work the next time. Complacency, after all, is just pattern recognition that hasn't yet encountered the exception. For deeper analysis of market psychology, Federal Reserve policy challenges, and the relationship between government functionality and long-term economic health, explore the resources and discussion questions in the description below. Understanding these disconnects helps you navigate both political headlines and your own investment decisions more intelligently.